All right, let's see here. Are there a few people here? I haven't done this before, so hopefully you can hear me. Can you hear me? All right, let's see. No. All right, let's make sure this works. I don't know, it's not seeing anything up here. I'm assuming that things will get recorded. Does YouTube length? Okay, perfect. So it looks like it'll save up to 12 hours. I'm not going to go that long. So we should be good to go. You can hear me. Fantastic. Thank you. That's helpful to know. I'm also curious if I'll be able to share my screen. No, that's share that. Let me see if there's any ability. Pop out chat. It'd be so nice to be able to share my screen if I need to be able to do that. Let's see here. Don't know if I can. YouTube Live, share screen. Okay. Oh, live streaming. No, live streaming with your webcam does not let you screen share. Oh, that's too bad. Okay, that's okay. I'll be able to kind of show you what I'm looking at. I'll just kind of say it live, and you know, you can always sort of Google along with me. So it's 3 o'clock, so I'm just going to get started. Thank you so much for joining me. This is an absolute experiment. This is my first time doing any type of live stream or anything like that on my own. So really the way I want to structure this is very unstructured. The goal for me is that this is kind of like an open doors policy that a professor would have at a university. Obviously, in this case, we're doing social isolation, so it's going to be an open window policy. Hopefully you also get my little pun about, you know, this is probably a window on your browser. Really, I just came up with this title this morning when I came up with this idea. Awesome. Hi, welcome. So really, you know, this is a pilot project. This is an experiment. I have no idea how this is going to go. Please let me know if there are any technical difficulties. So if you can't hear me at all, or if you can't see me, or if it's freezing up, let me know, and I'll try to troubleshoot in real time. I did get a couple of emails from people who did have questions who couldn't make it. And again, my understanding is that this will record, and I'll be able to upload it to YouTube or share the link, or in a dream world, like cut it up into a little like frequently asked questions, something like that. But you know, let's just get rolling on it. So if you have questions, I'm always going to kind of like, I think, take preference from the chat, that if you're here and you're live, and if you've got a pressing questions, then definitely like let's put the question there. Otherwise, like, I'm happy to give you a little rundown of how I'm looking at the markets and how I'm following things and like what I'm thinking about. Maybe I'll start by just giving you the update on my week and sort of how my week has been going. So obviously the market was not very good last week. It was pretty bad. And then Sunday night, I was up on Twitter and watched as the world oil prices collapsed. So basically, you know, just saw that Russia and Saudi Arabia have gotten themselves into a little pissing match or a price war. Or I'm not going to pretend I know what's going on, but you know, it was very clear that we were going to wake up and Monday morning, oil prices were down like 30%. So that was a big start to the week. Right away, I was feeling a little bit smug about my fossil fuel free portfolios. The fact that anyone had divested would, you know, sort of not be down as much. Little did I know that that it was going to fall even further. So all week long, it's continued to fall. And yesterday was the worst day in Canadian stock market since 1940. Now, obviously, the Canadian market is very heavily exposed to oil, so that would be one of the reasons Canada was sort of dragging a little bit. It looks like I'm getting some questions, and thank you. That really the question is, rebalancing. So obviously the process for our portfolio is we came up with a pie chart. If you're a client of mine, or if you've looked at my blog, hopefully you have a pie chart, and this is your plan, and this is what you want to stick to. When in terms of like how often should we rebalance, my one-liner right now is how often should you wash your hands? And the question is as much as possible. So really, when it comes to rebalancing, you really want to rebalance as much as you can. Now, keep in mind that there are often trading costs, especially if you just put money to work, like let's say like 2 weeks ago, meaning that you bought stocks like at the high before they came down. Then when you input the market values and you do the rebalancing right now, then what's going to happen is your stocks are obviously going to be down, meaning they're going to be a likelihood your bonds are up a little bit, not as much as the crash, but your bonds have gone up and are worth a little bit more. So when you punch it into the spreadsheet and you look at your allocations, and if you don't know what I'm talking about, let me know. But often, with my clients, I provide them with a rebalancing tool spreadsheet. And with this rebalancing tool, what you're going to want to do is input your market values, see what the current percentage is compared to your desired percentage. You can put the rebalancing number, the amount of cash at 0, and just like as if you don't have any cash to invest. And then obviously what you're going to see is that some of those figures are going to be in a negative, typically your bonds, if you just bought, which means that it does want you to sell your bonds that you're overweight. And what that would do is free up cash to then be able to buy your stocks. Now, if you had a portfolio and you haven't rebalanced in like a year or 2 years, then there's a good chance that's when you probably don't have to do anything. So, because what's happened is the stocks would have gone up, which is great, but then now they've kind of like come back down to like probably where they were, I don't know, like a year ago or a year and a half ago, depending on like what you bought. I really wish I could share my screen with you, because I'd show you sort of on a chart exactly kind of how far things have fallen. We can go back in time to see when it was like this. But that, chances are, if you haven't rebalanced for a while, don't stress out about it. Really, it means you probably don't have to do anything, that you're probably close to the right mix. But, the issue is, you want to now learn your lesson that when stocks were doing very well, you should have rebalanced. And that would have told you specifically if you had more money to buy more bonds, because if we own more bonds, that means we've got cash to free up when things are cheap. You can see my dog here is making a little cameo. Hi, Irie. Yes, she's very cute. Hello, say hi to YouTube. Yes, she's very sweet. So hopefully she doesn't bother me too much. And we'll, if she does, then I can always just grab her some snacks and she'll be good to go. So, okay, so here's a couple questions. So come on, Tim, for an average person here, rebalancing takes a couple days at best. What's the point of doing this? So why does it take you a few days? Do you own mutual funds? Is that the point? If so, this is why I love ETFs. ETFs, you should be able to rebalance your portfolio like in real time to be able to sell shares of one thing and buy shares of another thing. So if you've got mutual funds, like you own ETFs, that you can sell your ETF, free up that cash, and then buy other ETFs right away. It really shouldn't take you longer than like 10 minutes. If you're not comfortable with the spreadsheet, maybe a little bit longer. Okay, a couple of people have a question here. Was waiting to sell my mutual funds to buy my ETFs as part of the plan. How long should one wait for stability to do this? So when it comes to this, what we want to do, okay, hold on. Give me 1 second. I'll be right back. And let me get something. I should have been prepared for this. All right, let's go, Irie. Come on. Come on, Irie. Let's go. Let's go. Come on. Come on. Let's go. Come on. Up. Go. Go. Yeah, she knows. This dog has me trained very, very well. Sorry about that. Okay, so when it comes to mutual funds and looking at stability, what we want to do is look at something called the VIX, the Volatility Index. So what you can do, what I'll suggest doing, the platform that I use is Yahoo Finance. I really wish I should future videos. It's kind of a must that I'm able to share my screen. But for now, if you can just go to Yahoo Finance is the tool that I use. And what you're going to do is look up the letters VIX. VIX. There's going to be a little like hat, or I think it's, what is it, the Chicago Exchange, but this is a volatility index. So the VIX is a measure, a real-time measure of how volatile the stock market is. And what you can do is you can look at where, I would suggest looking at the 5-year chart. So once you've looked up Yahoo Finance and we're looking at the CBOE Volatility Index, VIX, you can see here that really over the last 5 years, it has stayed fairly consistent. There were spikes in 2015. That was probably the oil crash. And then there was the spikes in December of 2018. Remember when the stock market dipped down and then jumped right back up. And then from there, you can see now all the way up to the VIX peaked yesterday at 75.47. So that's obviously a very, very high measure. So when we talk about waiting for volatility to come back down, what we're doing is we're talking about waiting for this VIX to settle back down. Now, I don't know when that's going to happen. I also don't know exactly what a good range is. You know, at what point is it like safe? But if I had to choose a number off the top of my head, I would say when the VIX gets back below about 20, that's when markets have settled. And not if it just like dips back below 20 for a minute, but I would say like once it's below 20 for like at least a few days or like a week or so. Really what I would suggest with this, when it comes to switching mutual funds, you really don't want to sell mutual funds and then have a lag of a few days, right? Or if you're switching your whole RRSP, it's a few weeks. So we really don't want that because there might be a situation where the market jumps right back up. Oftentimes it does. We have these declines and then it jumps right back up. So that's why I would say wait until the VIX falls below 20. At that point, you're kind of free and clear to be able to do it. Hopefully that's helpful to you. I will come back to Anatoly, your question. You can sell shares quickly, but transaction takes several days to clear. So, and again, it depends on your broker, but most online brokers, the way that it works is that you can sell something, and even though it takes 2 or 3 days for the trade to settle, you can actually buy another stock or an ETF right away as soon as you've freed up that cash, because the purchase for the settlement for that purchase is going to settle at about the same time. So I've got no issues when it comes to like selling something, and then if you sell a stock or you sell an ETF and then you want to buy it back, like if you want to sell your bonds, really what I want you to do is to buy those stocks right away. By the time the trade clears and settles when it comes to your bonds, it'll also clear and settle when it comes to your stocks. And as long as I've been trading, I've been selling and then buying shares on that same day. So I hope that that clarifies. And this, obviously, if there's less of a lag, if we can do it so quickly using online ETFs, that does mean that you can do it like, I'm not going to say as often as you wash your hands, like after every meal, but really what we want to do is really kind of do it whenever possible. I don't think daily would make sense. I think that would be like overkill. But obviously, after a huge move like yesterday, I would definitely want to rebalance my portfolio. And then after any like major moves, that's when I would probably want to rebalance my portfolio again. Does that make sense? Hopefully. Okay. So other questions here. Is there opportunity for someone who doesn't have a big portfolio yet? What should we buy? Oh, if I had the crystal ball, where is the crystal ball? Mind you, if I had a crystal ball, I think my dog would probably eat it. So I wouldn't have a crystal ball for long. So basically, I have no idea. I don't know what to buy. I don't know what to sell. I don't know like anything in terms of what the market is going to do next. That's why I say, stick to the plan. And really my mantra right now is keep calm and rebalance. And that's going to be the message you're going to hear from me over and over. If anyone's like, is now the time to buy? I'm going to say I have no idea, but now is a good time to rebalance your portfolio. That in times like this, oftentimes markets do overreact. But we are in uncharted territory here, that with this coronavirus, that nobody knows what's going to happen. So any of the advice that you're seeing online where it's like either, run for the hills and time to sell everything and, let's put it all under the mattress or like buy gold or something like that is useless At the same time, anyone that's telling you now's a buying time, that let's go shopping, that like the whole stock market is on sale and let's go buy now. I don't like either of those perspectives. That to me, it's like, hopefully you've done the work ahead of time to like come up with an investment plan and that you know what things you're going to own. And my preference is going to be these broad ETFs. From there, what we're going to do is just simply, rebalance our portfolio, and that, hopefully you already know what you want to buy. So the things on your shopping list should be the shares of ETFs or of companies or whatever your plan is, but the things that you already wanted to buy. To Anatoly's point, market is run by pros. Do you imply that a regular guy like me can outsmart them by rebalancing? No. What I'm trying to get you to do is to get the market returns. I don't want you to beat the market. I don't want you to underperform the market. I just want you to get the market return. In terms of 2 ETFs in your RESP, yeah, absolutely. You should probably rebalance. I mean, chances are your RESP is pretty small, so it might not do a lot. It might not do a lot. You can really, what you want to do here is follow the spreadsheet. If you do have a large sum invested, then absolutely you would want to rebalance your portfolio. Chances are those 2 ETFs that are in your RESP, Raluca, are one's a stock ETF, one's a bond ETF. So I'm guessing one is down by a lot and the other one is up by a little bit. So again, use the rebalancing tool. And what you want to do is likely sell some of your bonds, free up that cash to buy stocks because they're a lot cheaper now. So that's really the game plan. Now, there are trading costs when it comes to selling, right? So this is the other thing, I didn't talk about this, when it comes to, as often as washing your hands. There are trading costs. Now, a lot of brokers like Questrade do allow us to buy ETFs for free, but there is like a $5 cost to sell ETFs. So what you want to be doing is really making sure that when you do the spreadsheet, you don't want to be selling, right? If it's telling you to sell less than a certain amount, because it's just not worth that $5 commission, right? So typically the way I do it is I would only sell if I'm less than about, if it wants me to sell more than like $1,000. If it's 500, between 500 and, but if it's less than $500 that it wants me to sell, I mean, I'm not going to pay a $5 commission. So, what I would suggest is do the rebalancing tool. If it's telling you to sell more than 500, then don't. If it's telling you, or if you get free, if you can trade for free, great. It says ETF buys and sells are free with Qtrade. Only some. There's a list that they have. And sadly, a lot of the ETFs are not on that list. Questrade, if you're listening, add the sustainable ETFs to your free ETF list. I would be so happy if they did that. So if you can trade for free, then rebalance like as often as you wash your hands. If there's a transaction cost, obviously you do need to consider that. And like, don't sell things if it's less than 500, or if you are like paying like $5 or $10 a trade, don't buy things, if it's less than 500, like wait until the numbers are a little bit wider in order for it to be like worth it to do that rebalancing. So really the mantra is like, stay calm and rebalance. That would be the big thing. Would you still sell bonds if you had cash to invest? Or would it be better to go in deeper now, i.e. use RSP or TFSA room? So if you've got cash to invest, that's fine. I mean, to me, it's like, it's up to you. It really depends what you want to be doing. And again, you can use the rebalancing tool and use the amount of cash. You can start at 0, or if you do have more cash that you want to put to work, you can just do that. It's really up to you. What I would say in terms of like going in deeper, this kind of dovetails with the question that's above, which says, okay, I hear you on not buying now. Is there a safe investment option other than the high interest savings account, something like that? So I did write a blog post about this, sustainableeconomist.com. It's like, Tim, what should I do about the coronavirus? Where I talk a little bit about this. Basically, what I would suggest is that, use the rebalancing tool, but by all means, feel free to like use your instincts and to create a little bit of either an aggressive posture or a defensive posture. So if you think markets have overreacted and you're like, yeah, I wanna get out of here. Hey, come on. Then in that case, what you want to do is really have a little bit more in stocks, or just simply put more money to work in your plan is a great way of taking that slightly more aggressive posture. Whereas if you want to take a bit more of a defensive posture, then what you would do, nice catch, is basically hold on to cash. And that if you want to hold on to cash, or maybe even put like an extra like 5% into bonds, something like that, you can always play with your asset mix. Really, we want to avoid the like all in or all out moves. And instead, what you want to do is really kind of like, have things just a little bit, skew them just a little bit. So bump things up by 5%, here or there, or like keep cash in a high interest savings account, or, put it to work if you are comfortable being aggressive. For me, I'd be a little bit cautious getting aggressive right now. Obviously, you want to have your emergency fund. But if you do have some extra money that is beyond your emergency fund that you are comfortable putting to work, that's when, if you wanted to go in deeper now, it might actually end up being a good time. I don't have the crystal ball, so it might go down lower. But again, if we're looking at this from a long-term horizon, I don't think it's a bad time to invest otherwise, as long as you're keeping your appropriate risk level. From there are a number of options. So high interest savings account is probably the safest thing. If you don't want a high interest savings account, let's say your money is already in Q-Trade or Questrade, there are high interest ETFs that you can buy. So I talked about, there are a couple of these. PSA.to is, I know, one of them. So like PSA is like the Purpose high interest savings ETF. Yeah, here it is, Purpose high interest savings ETF. I really wish I could share my screen with you right now. I mean, the yield is low right now. It's only paying 1.15%, which does have a management fee of 0.15%. So you're really only getting 1%, which is quite low, which is why I probably prefer the high interest savings account. The other one, there was one, it did have a slightly higher yield. And again, keep an eye on these, because with interest rates coming down, they have lowered these. So let me just get the other one. Here it is. I'm just navigating from my blog here. And so we had PSI, and then we also had, what is it? Sorry, I swore it was here. CI First Asset, PSU. .u. That's the US version is PSU.u if you have US cash. And then the other one is CSAV. That's kind of cute. It's like C-Save, Canadian Save. And if we look up CSAV ETF, really what I'm looking for here is the yield on sort of like the interest rate on that. Oh, where is it? No, that's the press release. Here it is for the CI First Asset High Interest Savings ETF. I'm looking for the yield on it. Management fees 0.14. Distributions. Oh, I might have to do the math on the distributions. Oh, here it is under holdings. So you click on the holdings tab. You can see this is just a bunch of like cash accounts at different banks, and the gross yield is 1.75%. So yeah, so if your money is like in your broker and you want to keep it in cash, then you might buy something like CSAV or the Purpose one, which is PSA.to. At this point, C-Save is a little bit higher. So, if it was me, I would probably go with that one. In terms of other types of investments, the one thing that I think a lot of people ought to be looking at, I mean, I'm really sad. I was all set for the Green Living Show this week. This weekend, I was going to do this thing called the Impact Investment Fair, where I was going to showcase these amazing different impact investments that are on the lower risk. They are bonds for the most part. Some of them are, there were a couple other ones. But if you're looking for other like low risk, places to park your money right now, you might really consider doing a community bond. I wrote an article about it. It just got published in the, in Corporate Knights. So if you look up corporateknights.com, I think it should be on their website here. I saw them, sorry, I spelled that wrong. I know it went out on their Twitter feed. I'm curious if it's going to be like on their homepage yet. But yeah, here I am right on the front page. Look at that. Oh, I love my editor. Great photo. Impact bonds offer a safe haven for investors is the name of that article. And what I do here is I list a number of different impact bonds that are available. So CSI is doing a community bond. Sketch, which is a really cool nonprofit here in Toronto, they're doing a community bond. There are green bonds as well. CoPower is doing a green bond. They have an offering, although I'm hearing that they're close to selling out. So if you want to do CoPower, you might want to get that very, very quickly. And then from there, what we would probably want to do is also Solar Share. These are all bonds that are asset backed. Now, there are some other ones. There's some great impact investments that are available right now. Not all of them are asset backed. So, assuming you want something a little bit safer, if you're willing to take a little bit more risk, I see Sally Miller is in the room, so I'll give a shout out to the Fair Finance Fund. My understanding is that these are sort of like promissory notes. Oh, CoPower sold out. No way. Oh, I feel bad for them. That's bad timing, because I think that these green bonds and these community bonds are going to be really, really a hot ticket over the next little bit. So, fingers crossed that CoPower can find some awesome green energy projects, but good for them. I think it was like $5 million or something. So for them to sell out $5 million that fast, ooh, I'm happy. Okay, let me go through some other questions. Yeah, Solar Share. Okay, hold on. Oh my goodness, good for CoPower. I'm so proud of them. So, okay, so let me just get to a couple other questions. Okay, Anatoly, I've been answering a fair few years. You're taking me down the rabbit hole a little bit. Why would professional algorithms that run ETFs and index funds be a worse tool to rebalance than I can do manually? So I'm not going to talk to you about individual stocks. If you've got like an individual stock portfolio and you're talking about rebalancing your portfolio, good luck. This is why ETFs exist. This is why, to me, it's just like, ETFs are sort of where it should be. I hope I'm reading this right. But that basically, what I would suggest is really look at building like an ETF portfolio, a pie chart, and then from there you can rebalance that on your own. Okay, so would you still sell bonds if you had cash to invest? Oh, no, we answered that one. Do the rebalancing tool, put in the amount of cash. Your spreadsheet is going to tell you whether you should, add more money to bonds or sell. I can't do that. I've never bought ETF so far, but ready to do it for a small part of the money I have. Stock, but our meeting is soon. I'm too busy. Yes, I am very, very busy right now. I'm sorry. I've seen your email and I'm going to get back to you, but it's going to take me a day or two. So, it's the type of thing where what I would suggest is kind of like hang tight. If it's in individual stocks, if it's in things, then, really there is this question about whether you should hang in there or whether you should sell some of them. I would just say hang tight and wait, until we actually have a plan. And that really, at that point, again, hopefully the markets will settle. Unless you're able to like buy things right away, like sell them and then buy them right away, I wouldn't suggest making any moves right now. I would just say hang tight, hang in there. Things are down so far. They could go down further. Absolutely, they could. I have no idea. But at the same time, they could bounce back up sharply. And that bounce back up sharply, like you really want to make sure that's not what you miss. That if you had any investments in the market over the past couple of weeks, you took that dive. So the worst thing you can do right now is to sell all your positions and like go to cash without having any upside that if it does bounce back. So I would just suggest hold tight. What I'll do is I'll reply to your email. I'll ask Amisha, see if she can squeeze you in. Really, I think for my business, this is an exciting time. I feel like it's go time, that I'm going to have some big announcements coming up. And that I'll do everything I can to be able to accommodate my clients. And if that means I'm working longer days for the next little bit, then I'll do everything I can to make sure that you get the help that you need. Okay, congrats on my inaugural open window. What do you guys think of this name? Does that resonate? I don't know. I came up with it instead of an open door, my first open window. It makes sense to me, but I don't know if other people are going to get it. I might have to revisit that. Leslie, are there some sectors disproportionately impacted by the recent dip, i.e. opportunity to invest? For example, energy like Algonquin looks less impacted than got hit hard with this. And because, I think a lot of it, they are more dependent on GDP growth. It'll be interesting to see what happens there. Obviously, now, energy like Algonquin, I would classify Algonquin as a utility. So to me, I would say that, if we're looking at Algonquin specifically, which is AQN.TO, So I really wish I could share my screen right now because I've gone Yahoo Finance. And what I'm doing is I'm looking at AQN.TO, which bounced back remarkably today. So if I'm looking at the 5-year chart here, really what I can see is it looked like it went from a peak of 26 down to 16. So it lost $6 out of 20. 6 divided by, out of 22. So it did go down about 30%, but then it's rebounded a lot more heavily today, 7%. And it wouldn't surprise me if this is what you're seeing in the short term, that I think the logical thing that market, traders are going to do is a little bit of a flight to safer stocks. So typically safer stocks are going to be what we would call defensive sectors. So utilities, consumer staples, I'm trying to think, healthcare is often a defensive one. And certainly, I think someone made a joke about investing in masks and, things like that like medical devices. I'm curious. I'm just going to look up Yahoo Finance, and there's a medical devices ETF, IHI. And I can see, oh, it is hit pretty hard. Look at that. Okay, that's interesting. That is down a lot, and it has not rebounded much today. Those are US companies. So, we might see a little difference between the Canadian and the US markets today. But that basically, there are going to be some sectors that were hit harder by this. Personally, I would continue to stay away from energy. Energy is down the lowest. And I think most of you know my bias, which is that, I think that the world is going to be moving very quickly on climate change. And that as such, I would not touch the traditional energy sector. However, there might be some sectors that would be a good idea. Let's see. Irene, sit. Come on. Show off for everyone. Sit. Good girl. Nice catch. That that when it comes to these defensive sectors, utilities, consumer staples, I don't know about real estate. Real estate's going to be a weird one. I can't predict that. I'm not at the point where I'm looking for specific opportunities to see what's down more than others and, what do I want to go shopping for? For me, if I'm going shopping for whatever's already in my portfolio. And I'm just going to do that rebalancing. And I might tweak the percentages here. Like if I did own a company like I do own Brookfield and Intergex and Borlex as utilities, that, now they've done quite well. So I doubt my rebalancing tool will want me to buy too many of them. But, I might consider, increasing by like an extra 1% and then looking at the rebalancing tool and see what it says. Cool. Okay. So you like the name Open Window, Lee. Thank you. I'm so glad. Let's see. Every ETF has rebalancing algorithm. If I like my balance before the show started, why would I change? I'm not telling you to change the algorithm of the ETF. I'm talking about the balance of the ETFs within your portfolio. So we're not messing around with the ETFs at all. We're trusting the ETFs. But what we're going to do is make sure that we're managing the balance of the ETFs that are in our portfolio to make sure that we have the appropriate level of stock ETFs versus bond ETFs. Here's Drew. Hi, Tim. If my portfolio rebalancing tells me to sell some stocks and buy others, should I? Or should I just move bonds to stocks? Oh, so if your rebalancing tool is telling you to sell some stocks and then buy others, that means that, this is kind of the point that some things have been harder hit than others. So the things that it wants you to sell probably haven't been hit as much. That's good news. They're up. If it wants you to buy the other things, that means that, those things are down a lot further and could be a buying opportunity. Obviously, I don't know. But again, it doesn't matter to me in terms of stocks versus bond, like that whole thing. I would look at the dollar amount, so the amounts under that investment column. And what you're going to want to do is basically, if it's more than like $500 or $1,000, then yeah, like sell one stock and, or one stock ETF and buy the other stock ETF. Absolutely. Really, if it's less than $500 or if it's only like a marginal amount, don't bother. It's just that obviously this is, in this type of volatility, this is when our pie chart is going to get more out of whack. So if it gets out of whack by more than like a large amount, I would say $500 to $1,000 in real time to avoid those trading costs eating away at a huge percentage of your returns, then absolutely, I would suggest rebalancing. I have no problem waiting a little bit. You don't have to like rebalance right now, rebalance today. You do have half an hour left in the market open before it closes for the weekend. So if you want to do it right now, by all means, go for it. But at the same time, don't feel like you're in a huge rush. The big thing to me is the overall mix of stocks versus bonds. So to sell one stock and buy another stock, it's a little nitpicky, but I would absolutely still do it. Okay, so conglomerates like Brookfield Asset Management. Yeah, again, I don't know. I haven't looked at it. I haven't had the time. Like in terms of like these individual companies, every company is going to be behaving so differently when it comes to this. So if you can get a deal, if you feel that it's a good price, go for it. Do it a small percentage of your portfolio. And again, I'm less concerned about like picking and choosing sort of what to buy, what to sell. And it's more about like sticking to your plan. Okay. Anatoly, I'm loving this enthusiasm. Of course, you do not hold individual stocks. So glad. Sorry, here we go. Yes, every ETF, where is it? If one believes, as I do, that what we see now is a temporary storm, then any manual rebalancing of index ETF portfolio will work against massive algorithm. No, okay, I'm not even going to go there. I have to leave. If you're recording, yes, I'm recording you. Let you know. Yeah, if you liked your portfolio before the storm, great. But you don't have the same portfolio that you had now before the storm. That your percentages are way off compared to where they were a month ago. So if you like that portfolio before the storm, I'm telling you, go back to that portfolio now. That do the rebalancing to get you back to that original mix. Rosalinda, you like the name. Okay, fantastic. So I'm not the only corny, cheesy one. Nishat, welcome. You like the name too. What reasons do you have to believe that a snapshot of the market at some minute of some day is an adequate signal to rebalance? Why not 1 hour later? Again, this is why it's a crapshoot. I can't tell you. I have no idea. But the fact that stocks went down by like 7 to 10% yesterday, that's your signal to rebalance. Like when you have a major move like that, that is going to dramatically change your asset allocation. So this is exactly the type of scenario. When it goes up, all of a sudden you have more risk than you should. In this case, with the market coming down as sharply, like we've never seen this before, everyone's portfolio is actually going to be less risky than they want it to be, right? Assuming that it was where you wanted, a month ago, everything is coming down. So by rebalancing, I'm actually telling you to take the appropriate level of risk. That you want to sell your bonds and you want to buy stocks. And if you were 60-40 before, right, 60% stocks, 40% bonds, you're probably like 50% stocks, 50% bonds. I'm telling you to go back, sell some of your bonds, buy the stocks when they're cheap, right? Go back to that 60-40 mix. Now it could go further. And if it goes down further, then you're going to do the same thing. Rebalance again, go back to that 60-40 mix. If it jumps back up, now all of a sudden you might be in a risk where you're, 65-35, or what would it be? Like 65-35. That now we're in a situation where you actually want to sell some of your stocks and buy bonds. That really it is that overall percentage. Cool. Okay. So do we have any other questions? I think I'm up to date on this. I feel like I've done pretty well here. How's everybody feeling? How's everybody doing? I do have a couple things to go over, just like questions I got from emails. I did a post on Reddit that, I put up a new model portfolio and got some Reddit, but I just want to give you guys like the full attention that if there are any other questions. Okay, I see one here. My partner has become more aware of how her CIBC broker is managing her investments. He has 100% in equities on the TXX in just 3 stocks, oil, chemical, seniors. How can she get out of this mess? Oh my goodness, that's a tough scenario right now. So obviously you need to be more diversified. If it's just 3 stocks, then you really need to know whether you want to keep owning those stocks or not. My first instinct is to tell you, like, don't do anything right now, right? Just because it could bounce back. And so, have a plan for what you would buy with those. But like, there's this expression we have, which is catch a falling knife. And in this coronavirus situation, if we're on lockdown for the next 2 months, some companies are going to go bankrupt or have like really, really, really bad quarters where the price is going to fall dramatically. And so what you're asking me now is like, really dependent on what's going to happen to those 3 stocks. And I have absolutely no idea. My instinct is figure out what your game plan is, whether it's moving it to a robo-advisor, whether it's doing, yeah, oh, this is a broker who did this. Oh yeah, fire the broker. Basically, you're gonna wanna get out of this. What you're gonna wanna do is figure out where you want your money to land, whether it's an online broker, whether it's a robo-advisor, whether it's something like that. But again, it's just so hard with just 3 stocks. I don't know, I don't have that crystal ball, so there's no way to do it with like optimally. The best thing I can suggest is to find a nice diversified ETF portfolio, either doing it yourself or there, and from there just make the switch. Write that broker a very bad review on Google. Tina, thanks so much for this session. Makes me feel a lot more confident. Really glad I worked with you. Oh my goodness. Thank you. I'm so glad. Anatoly, I think you and I can agree to disagree. You're welcome to your opinion. I'm going to say something different. To rebalance, you need to do it before 4 p.m. Yes, you have 21 minutes, Lisa. If you have it sorted, let me know. I can answer specific questions in here. Haley, so nice that you're here. Is the best time to rebalance ASAP, or are there other signals we should look for to cue a good time? Doing it today, not in the card, so no, don't do it today. I'm joking with Lisa. Oh no, Gail has lag. Oh, I hope there isn't lag. I think it is recording, so hopefully we'll be able to get that up. But with good time to rebalance. If I knew the best possible time to rebalance would be to do it at the exact low of the market, I have no idea where that is. It could keep going down further, but now is not a bad time to rebalance, is what I'm saying. So to me, it's really, it's the type of situation where, what I would suggest, again, I think what I'm going to have to do is really kind of open up my calendar. I'll talk to Amisha over the weekend and let me see if I can open up some slots. Really, I think that if there is like emergency rebalancing, or not emergency, but if you're like, people are feeling a little stressed and they want to do a rebalancing right away, hopefully I can just open up slots specifically for that purpose. And that way we'll be able to get you sorted. There is no perfect time to rebalance. I can't, well, there is at the low, but I don't know when that is. So all I would say is that now is probably a good time to rebalance. But really what it comes down to is you want to do that rebalancing tool spreadsheet. And I would say take a shot at it. Haley, you can email me the completed spreadsheet, but take a shot at just filling it in without doing any trades. But what that'll do is tell you kind of how off you are. And then depending on how off you are, that's when you know whether it's going to be like a major rebalance, or maybe it's just a couple small little things that are off, especially if you haven't rebalanced for a little while. It could be that we're kind of right back to where we were when we started, in which case you might not have to do anything except put the extra money to work. That you'll have these dividends and interest payments that do accrue over time. So obviously we're going to want to put that to work, but it really depends on the math. I'm really going to suggest fill out the rebalancing tool and send it to me if you need more help with it. And that if it does have some big numbers in that investment column, right, what we can do is to absolutely get you sorted out. Okay, let me go through. We got some more questions. Fantastic. Thank you so much. This is so cool. There are questions. This means so much to me that this is working and helpful. If we have an ETF, like some smaller companies like PZD, should we adjust our portfolio to that by 1% or so because of the chance that they may go under? I mean, yeah, if you wanted to take a more defensive position, if you thought that this was going to be bad news for the green economy and something like PZD, then, might not be a bad idea to just turn the dial a little bit down on that. Let's take a look at PZD. Let me see how it's doing. I so wish that I could share my screen with you, but I'm just going to Yahoo Finance. I'm looking at PZD. It's down to about $37, $37.61 right now. Which puts it back, just to give this context, this is right where we were at the bottom in December of 2018. So right at the bottom, remember when there was that dip, that's where we are back. And then previous to that, we're back all the way to April 1st, 2017. Wow. So, about 2.5 years of gains just wiped out like that. Now, again, it could bounce back. We'll see. I would suggest that looking at the a lot of the companies that are in here, although they are going to be a little bit more small cap, and there is a slightly higher chance they could go bankrupt, I'm not really seeing it affect this sector too much. If anything, the issue with clean tech is that with the price of oil being so low, that kind of like discourages a lot of the adoption of these energy efficiency technologies. That now it's like, hey, why would I get an energy efficient car? I can keep going doing my gas guzzling SUV because the price of gas is so cheap. So that would be my only fear, that the economics on green energy and this sort of low carbon transition are worse than they were a couple weeks ago because the price of oil is so much lower than it was back then. That said, my impression is that, we are still at the start of this transition, and really less for sheer economic reasons based on the price differential, but based on climate change reasons. So for that reason, I'm not going to change my allocation at all. I think I've got PZD at like 4% or 5% of my portfolio with a few other green ones. So I'm going to leave mine as is. But by all means, if you did want to take a slightly more defensive posture, I would fully support just tweaking it down by 1%. It's not going to make or break anything. It just means a little bit. Okay, so from there, yeah, I really hope that this the leg isn't too bad, or that at least the recording that I can send out. People are saying it's helpful, great. Is now a good time to buy a green bond, or is it better to hold cash? Really the big difference there is going to be liquidity. A green bond is locked in for like 5 years. So if there's any reason you might need this cash for the next 5 years, I would say hang on to it in cash. Like that would be my default setting, is like keep things in cash, especially for the next few months. I think there's a good chance we're going to go through a recession, that a lot of people might lose their jobs, that a lot of people might get laid off, and just like, that emergency fund that you have, my guess is that people that don't have an emergency fund over the next year, over the next 3 months, 6 months, 12 months, are going to be in more trouble. This is a time where we want our emergency fund. Now, if you have your emergency fund and you're good to go, and you've got your backup plan, and you've got like your cupboard full of like, a month's worth of food, and you have your garden that you're growing, and you're like, Tim, I'm going to be fine. I can survive the zombie apocalypse no matter what. Then, if you've got money that you do want to put to work, then absolutely, doing a green bond right now, 5 year, you're locking in at 4%. I mean, 4% was a decent return, a few weeks ago. It was like, hey, that was like, slightly better than what I could get with a traditional bond ETF. Now that interest rates have come down, the Bank of Canada just cut them by 0.5%, like overnight last week. They just boom. So a lot of these funds are lowering their interest rates. So if you can still get a green bond at 4%, it's actually worth more than it was a few weeks ago, right? Because it was, 4% a couple of weeks ago was like, hey, not bad. Yeah, okay, I'll take it. 4% now is like pretty darn good. Now obviously I don't know what's going to happen to interest rates over the next 5 years. So when it comes to these green bonds, they are a fixed interest rate, which means that you basically win. You're better off if interest rates go down, right? Because you're getting your 4% no matter what. But you would lose in a scenario where interest rates came back up, right? Because your money's locked in for 5 years. So really for me, in answering that question, it's going to be, number one, do you have an emergency fund? Do you have enough cash? Do you feel confident that you can put this money to work and not need it? And then number two, it's going to be, again, sort of that liquidity and the extra risk that you are taking. There is risk when it comes to these green bonds. That, are you comfortable taking that extra risk in order to get that extra return? In my mind, it's a coin toss, but it's only a coin toss really if, my liquidity needs are good. If there's no reason I would possibly need that cash. Okay, no leg. Anatoly, you're just coming at me here, so I'm just going to start ignoring you. Nishat, there is some lag, but not too bad. So good. Am I saying the R word already? Oh my goodness, I'm sorry. I'm sorry. I shouldn't. I know this is a reference to West Wing, and I shouldn't have said the R word. I'm so sorry. But in fairness, other people are saying it, so I wasn't the first. And, hopefully we should, but the reality is, we don't know what kind of impact this is going to have. We don't know how our governments are going to respond to this. I'm confident that the economy will be fine, that I think we're going to take a nice deep breath for about 3 months. and then it'll be, sort of not quite back to normal. I think this will change things. I think a lot more people are going to like avoiding their commute once they get a taste for what it's like to work at home with your dog. So it'll be interesting to see, but definitely there is the possibility, and especially what I would say is to is that, how can I say this? With Canada as heavily exposed to the oil sector as we are, there's no doubt in my mind that Alberta is going to go into recession. That I think that sector is going to get hit really hard over the coming months, worse than other sectors. Unless Russia and Saudi Arabia, get their act together and are able to have an agreement. But if that doesn't happen, then, really the sector is going to be in trouble. So that is going to affect Canada. That is going to affect our economy. And definitely we could look at that. Okay, so let me see here. Maybe on Zoom. I've looked at Zoom. Zoom is so expensive. Can I tell you how much I would have to pay to do this on Zoom? Okay, let me play with my settings and with this YouTube live thing. But this really is going to be the easiest way for me. Let's see here. Is main goal of rebalancing during a volatile period to try to max making more money? I mean, yeah, it's two things. One is it's keeping your risk level appropriate, right? So if the market has gone, dramatically up, like volatile up, then we have too much risk. And so we want to keep it our risk level. We rebalance to get back to our original risk level. If the market falls, which it's happened, now most people have less risks than they should. Right, which is why again we rebalance to get us back to our original. So there is this notion. The reason that we do say that you want this diversification between stocks and bonds is for these more volatile periods. Right, that right now after the crash, if we're able to rebalance and free up a bit of cash and keep our risk level appropriate and buy more stocks now, even if we don't time exact the bottom. If we keep buying while it's going down, and maybe even we keep buying as it's like coming back up, then yeah, we're going to benefit the most from that boost. So really, this is about long-term profit maximization for sure, but through the context of keeping the appropriate risk level of your portfolio. I hope that makes sense. Okay, Andrew, hey Tim, apologies if you addressed this already, but curious about your thoughts on Canadian government bond funds and how they've moved in response to this crisis, specifically the dip this week. So yeah, so I have been keeping an eye on my bond funds. And again, I wish I could share my screen with you. Screen share feature. But basically what I'm gonna do here is, I'm gonna put up an indicator on Yahoo Finance. So, maybe we can look at the broader stock market. So what is it? XIU is the TSX 60. So XIU.TO would be the Toronto stock market. This is the TSX 60, very standard measure for the Canadian stock market. From there, what we would do is go to chart. I'll look at the 1 month chart so we can just look at the crash. I'm going to add the comparison, and I'm going to add something like ZGB.TO. ZGB is the BMO Government Bond Index ETF. I'm going to make that one purple so that I can see. So what I can see here is over the last month, the Canadian stock market is down 25%. It hit a low of almost about 30% yesterday. It looks like we're going to end the day up about 5%, 6%. So yeah, so it looks like we're going to sort of end the last month down about 25%. Whereas government bonds are up about 2%. Now, what's really interesting to me is that if I look at the period from, it looks like March 5th until March 9th, the stock market went down considerably, and my bond ETF went up, right? Now, that probably coincided with the change in interest rates. When the Bank of Canada cut the interest rate, that's when I would expect the value of my bond ETF to go up. Now, the troubling part is that since March 9th, the global stock market is down a further like 6%, and my bond ETF is down as well. Now, not exactly the behavior that I would want to see from things that are inversely correlated. That said, it's such small data points, it's so small that like on the aggregate, I would say that my government bonds are absolutely behaving as expected. I am hearing some little murmurings. It's not something I can really speak conclusively about. But really what it is, that I think there is a little bit of funniness with the bond market when it comes to discounts or premiums. So when it comes to ETFs, the price is usually based on what we call the net asset value, which is the value of all the assets inside the ETF. Now, sometimes what will happen is that markets will, it'll either oversell or it'll get overbought, and it'll go a little bit above or below its net asset value. At that point, it's trading either at a premium or at a discount to its net asset value. And I have heard of bond ETFs trading at a discount, so below their net asset value. So that's something I'm going to be keeping my eye on. It's no reason to panic. There's nothing, I don't think it's anything too serious. My guess, it's just a short-term sort of inefficiency in the bond market, is my preliminary looking. The only other thing I will say is someone pointed out to me, I saw there was an article this week in the National Post that Newfoundland is in serious trouble, that the government of Newfoundland, there's a chance they might need to declare bankruptcy, which would be a huge thing for a Canadian province to declare bankruptcy. Now, obviously, in a government bond ETF, Newfoundland bonds are going to be the smallest of slice of that percentage, but a little bit of tidbit that I did learn this week that I'm happy to share. Amanda, I prefer Zoom too. Okay, interesting. So this is good. I just want to make it, I guess with Zoom, I can still post the link everywhere. I can do anything. Maybe I will try Zoom next time. I don't need that amount of money for 5 years. Yes. Any suggestions on which ones to buy? Well, there were only 2 green bonds that were available. There was SolarShare and CoPower, and I just got word on this call that CoPower sold out. So Sia, I just want to check, are you a resident of Ontario? If you are a resident of Ontario, I think the only one left is SolarShare. Oh, did I miss a question earlier? Oh, about bid ask. Hold on, let me find it. Where is it? Oh no, I missed a question. Let's see here. Okay, the bid ask is very wide right now. Yeah. How to best take advantage of this? You can't really take advantage of it. Really, the bid ask works against you. The bid ask is only going to hurt you because the bid, the low ball, right? That's what people are trying to buy it at right now. The sell is the high ball. That's what people are trying to sell it at right now. This tells me that it's just like the markets aren't very efficient right now. And especially when it comes to some of these more sustainable ETFs where they are smaller and so they're more thinly traded. This means there aren't as many people buying or selling them. That what we're going to do is really look at that bid ask spread and understand that really that is going to be the gap between the bid, the low ball, where if we had to sell, we would need to sell it at, and the ask, the high ball, which is where we would buy it at. The wider that gap is, the less happy I am, the angrier I am. Because what it means that is if I buy that ETF, I'm going to buy it at the higher. And if I have to sell it right away, I'm going to sell it at the lower. So this is where, we do get in this idea of the price of the share versus the net asset value and whether the ETF is trading at a premium or at a discount. A wider bid-ask spread suggests that we're likely paying a wider premium or a wider discount, which is not generally a good thing. This is why it's like, but then again, part of this process is like, we don't try to time the market. So if you were to overpay for an ETF by 10 cents a share, that's not the end of the world. Obviously, it's not perfectly efficient. And this is why I want more people buying these sustainable ETFs, right? And this is why I want that. But, really the goal here, I think, is just to put money to work, or, if you need to pull money out, to pull money out. That I really wouldn't be concerned about those pennies that are involved. If it's more than 30 cents per share, something like that, that's when it becomes a little bit absurd. That's where, you might consider just not trading, just shut down the browser. That just things are just so much more volatile right now than they normally are, that it wouldn't surprise me if we get some more of these inefficiencies, some more of these little not like glitches, but just really they are inefficiencies, that there aren't as many people in buying and selling as we would like. Or it could be a situation where there are a lot more people selling than buying, or there are a lot more people buying than selling. Again, it tells me that it's not a market in equilibrium, which is a bit of a concern, but by all means, not the end of the world. Okay, yeah, if you limit it to less than 45 minutes, I should be able to use the free version. Okay, I'm gonna look at Zoom. I also feel like maybe this is a stock to buy right now. Really, like I feel like a lot of people are gonna be working from home and that Zoom is gonna be doing really well for themselves. We'll see. Okay, rebalancing, but cutting losers and adding more winners. No, yeah. Oh, if you know the winners are, Living Harmony, if you can please just like, by all means, send me which ones the winners are. That would be great. Okay, more people are telling me those. Okay, so, really, I would suggest, I know it's you, James. So really, I would suggest, be wary of sort of this winners or losers mentality. Certainly if you think a company might go bankrupt, yeah, we should like have a good think about whether you want to continue to own that stock, whether it's better to cut your losses and buy something else quickly. But two things: one, you better know what you're going to buy right away. I don't want that sitting in cash right now, right? Because we want it, if it does jump back up, we want to be able to ride it back up. And two is, I don't want you to sell a company just because it's performed poorly. That is not, everything is down right now. Everything has performed poorly. And especially if it's a company or a sector that we knew was going to be more volatile, that we knew was going to be a little bit riskier, there's a good chance it's performing as expected, that if it's down more than the other things. So, and that those are typically the companies that do, jump back up because they are more volatile. So I wouldn't suggest, sort of if you were to like trim the losers and invest in the winners, might be a bit of a problem. Just because, I don't want you to like sell things when they're at the low point and buy things when they're high point. Yeah, organic ETF has been not so great for a while. So absolutely, this is an ETF that has just stunk. And I think I've made it very clear to clients that, when it comes to ORG, the organic food ETF, that it's not a great one. And that certainly in a recession, I don't know if people are going to be buying more organic food over the next little bit. I can tell you that I did just stock up on a bunch of oat milk. I kind of love oat milk right now. So, so someone's going to be buying it, but maybe not. Organics is supposed to be collapsing. Is that, do we have more information on that? If it is going to be delisting, ETF delist. If it is getting delisted, if there is an issue like that, then that would be a great reason to sell it. I'm just going to go to the website right now, so I'm just looking at the Janus Henderson. I can see the year-to-date is down 25% as it prepares for liquidation. Oh, okay. Thank you for bringing this to my attention. On or about March 17th. Oh, I didn't know about this. Creation orders will no longer be accepted after the close on or about 3/12/20, and trading will be halted prior to market open today. Okay, fascinating. Okay, this is really good for me to know. I did not know that this was happening. Really, if it is closing and it looks like what it's going to do, so yeah, if it's value for some reason, then what that means, James, is that in likelihood we missed the date to be able to like liquidate it, which means that they're going to liquidate it on your behalf. So what we would want to do in this scenario is, since it looks like we've kind of missed the date, I apologize. This is the type of thing I wish I'd known about it. They should have been required to send out a notice, and that if they didn't, and I'm a little grumpy about that. But that what we want to do here is reallocate that portfolio. So what we're going to do is take those percentages in your rebalancing tool. I want you to look at the other holdings. I can't imagine this would have been a large position. Typically this is something that we do as a fairly small position within someone's portfolio. So I want you to take those positions and spread them around. If you're worried and you want to take a more defensive posture, then we would take those percentages, just put them in your bond ETF. That would be like the safe thing to do at this moment in time. That said, because it is a stock, it is an equity ETF, the typical thing to do would be to take those percentages and probably spread them around. If there are holdings that are like a higher percentage, you can do a little bit more into those. But like in a dream world, what we're going to do is take that position and then redistribute those percentages proportionately so that you end up back at 100%. Does that make sense? wow, that's going out of business. It hasn't been performing great. And but I'm sad. I'm really sad. I feel, let me do a little bit more research. Let me see if I can find something else that would be a suitable replacement to that. I feel like there might be a couple of other options, other ETFs that are available. Okay, what's this? Susie's oat milk, 6 cartons for $12. I'm not going anywhere near Costco right now. You could not pay me money to go to Costco or like to any place where there, I don't understand it. It's all like, what are we talking about right now? Social isolation or, social distancing. And it's like hundreds of people in line to get things at Costco. I think everyone's like separated just by shopping cart. Like a shopping cart is like, you're okay, please stay 1 shopping cart distance away from me right now. I'm not going to Costco at all. I just bought a bunch of bulk. I use there's like a wholesale delivery service where I just bought a bunch of them. They weren't that cheap, I can tell you that much. But I've got my oat milk, so I'm going to be okay for the next little while. Okay, we're over an hour now. I didn't put a stop on this because I didn't know. I'm happy to go a little bit longer if people do have questions. I would say an hour, I feel, is like probably a pretty good amount of time for this. Are there any other questions from the chat? Before I go, I will just quickly address a couple questions that I got through email. I think I had them. But okay, I think the chat is good. If there are more things, by all means, really the feedback that I'm getting is to try doing Zoom and to use that for the next experiment. Do you guys think I should do another pilot project? I'm hoping we will. From there, yes, my dog is adorable. She's sleeping behind me. I don't know if you can see her. She's now absolutely tuckered. Let's see if I can get her there. Oh, just kind of. She's down there. She's finally settled down. From there, what I'll do is, for the next little while, I'm thinking about holding these maybe like every couple weeks, maybe every week or so. The only question I had from the email, I think we already addressed it. Back in the old day, there were a utility sector was a boring investment that threw off decent dividends. What sectors are, for risk adverse investors? And I think we talked about that. Oh, someone's saying no to Zoom. Okay, let's see here. Okay, so best to keep buying question week if have cash to use DCA. Yeah, so I think right now is, in terms of if you don't know exactly what to buy, or if we don't know if there is an issue buying, if it's something like, I feel like in the chat, someone told me that DRFG was like $1 bid ask, like that's just absurd. That to me is a good reason to just like hold off for a little bit, see if it does. And then from there, use dollar cost averaging. So I love dollar cost averaging. To me, that would be the best approach, is like maybe like 20%, 20%, 20%. If you've got cash, to do it every week might be a little bit too frequently. I would say maybe like just slow it down a bit, maybe do it every couple weeks. Again, it depends on markets. So what you're going to want to do is do like maybe like 20% or 25% of your cash now. And then from there, see, and really it's, if there is another down day, that's the signal. That's when it's like you want to buy another 20, 25%. And then if there's another down day, really bad, then, you can buy another 20, 25%. Now, obviously, after long enough, we kind of run out, right? So this is why you want to spread it out. But the idea is that what we would want to do is to be able to have, cash available that you can put to work if it continues to go down. But, I think that now might be a good time to get started with a dollar cost averaging strategy. Yes, Katrusha, yes, it was recorded. I haven't done this before, so I think it goes automatically to YouTube after I'm done with it. And then what I'll do is just send it out to the email as an experiment, and I'll send it out as a newsletter, assuming this works. Open window once a month would be amazing. Okay, Tina, I hear you. We'll see. Let me see. I feel like I'm going to be like, people are going to be like just hanging out around their computers. So maybe I'll make it once a month, and then maybe I'll do it a little bit more frequently, like during like times of crisis or something like this. Kim, I think the government will have to do some incentives. Would be a good idea to keep money in case they do. What kind of incentives are you thinking they would do? If it never hurts to have cash around. So never hurts to just keep things in cash in case things change. That said, I don't think that the government would be able to really kind of like do something like it's not going to be around investments. There might be some incentives in terms of tax breaks. I could definitely see. I think this would be a great opportunity for universal basic income. For me, it's like, if we want to get through this, if we're just like totally self-isolation right now, let's just give every adult in the country $2,000, just cash. Here you go. And that way everyone can like survive for a month, right? Maybe do things like halt mortgage payments. I would be super down for that. Let's like halt all interest payments for like 3 months, and let's just take a little bit of time off, and everyone just take a deep breath and do it. So I wouldn't like, cash is king in these scenarios. So if you think there's going to be a change, if you think that things are going to get worse, then hang on to that cash. But otherwise, I would suggest doing dollar cost averaging, and you can invest a little bit. And this is my way I like keep calm and rebalance. If you have more cash to work, look at some of these different options. Look at doing dollar cost averaging if you are okay taking a little bit more risk. Vincent Young, YouTube is way more democratic. I hear you. That's why I chose YouTube Live instead of Facebook Live. I'll look at Zoom. If it's a better platform, where I can connect, great. But at the same time, it might just be a matter of playing with my YouTube settings. And maybe I can get a little bit stronger internet or something like that. But thank you so much, everyone, for participating. I'll send out the video via my newsletter. And if you have any questions, by all means, let me know. I am really behind on emails right now. I'm so sorry. I'm so behind on emails. But I do have at least the next couple days off, and then most of next week I'd kind of booked off for like business development. So, again, I'm going to see if I can open up some slots for some emergency rebalancing meetings. And then also, really my goal is to get completely caught up on emails. So I really appreciate your patience there. We survived. The markets are now closed. It's after 4 p.m. on Friday. So there's nothing anyone can do until Monday morning. So get some rest, hang out with your family, get outside in safe, non-crowded areas, and keep calm and rebalance. Hope everyone has a wonderful day. All the best.